Good morning or good afternoon, everyone. My name is Ettore Greco. I'm the Executive Vice President of this institute, International Affairs Institute, and I'm very pleased to open today's meeting, whose title is Financial Sanctions and the Future of the International Monetary System. The overall objective of this meeting is to examine and discuss the implications of the continuously evolving policies of financial sanctions by Western countries for the international monetary system. This issue, as you know, has become increasingly topical, especially in the last few months, not least because of the deepening debate in the West on whether and how to use the frozen Russian assets to help Ukraine. Those assets amount to about $300 billion, and most of them are under European, not US control. The debate has intensified following the Ukrainian military setbacks and the failure of the US Congress so far to pass the package of $60 billion to support militarily Kiev. There is, in other words, a sense of urgency in the West that more should be done to mobilize additional funds to counter Russian aggression. At the last summit, EU leaders decided, as you know, to go ahead with a plan presented by the Commission to use proceeds from the frozen Russian central bank assets in Europe to support Ukraine. The bulk of the profits would be used to finance military arms delivery to Kiev through the European Peace Facility. Profit from the assets are estimated to be every year to be between 2.5 and 3 billion euros. If the proposal is eventually approved, the first 1 billion could be disbursed as soon as July the 1st. The proposal seems to have a broader support from EU countries, including France and Germany. However, some Western banks have voiced their concern that if implemented, the EU proposal can lead to costly and prolonged international legal disputes. Financial institutions would need, in any case, to anticipate those costs. The wider concern is that the trust in the Western banking system could be eroded. Russia, in turn, has repeatedly threatened to retaliate. It must be recalled that Moscow has already seized assets in response to Western sanctions. It is also worth mentioning that other options are being considered for mobilizing funds for Ukraine, including issuing European defense bonds or enabling the European Investment Bank to invest in military technology. In any case, the EU plan does not envisage, for now, the confiscation of the capital of the Russian assets. However, US and Canada, while supporting the EU plan, which has been discussed with them, are in favor of a more robust action, including confiscation. The push in the US Congress in this direction is particularly strong. It is also worth mentioning that US Treasury Secretary Yellen has explicitly downplayed European concern that seizing Russian assets would undermine the role of the dollar, the yen, and the euro as global reserve currencies. The issue has been discussed for more than a year within the G7. Most recently, as you know, at the G7 finance meeting in February, where deep divergences emerged. Perhaps there has been since a process of convergence, but there remains clearly the risk of misalignment between the EU, Britain, and US, and this would obviously be a major complicating factor also for financial institutions. In that context, the deliberation at the G Summit in June would be extremely relevant, and the Italian presidency could be called to play a crucial consensus-building role. Against this broad background and the rapidly evolving diplomatic scene regarding this specific issue, what we want to discuss today is the most specific but extremely relevant issue of the impact of these potential additional sanctions on the financial and monetary system, including in particular the prospect that they can accelerate to some degree the development of alternative financial market infrastructures and undermine the international role of Western currencies and the related risk of a growing fragmentation of the financial system. As in the case of other sanctions, it is also important to discuss how these effects can be addressed or mitigated in order to avoid major destabilizing dynamics and preserve the global financial stability. This implies considering the interplay between Western sanctions and long-term trends that are likely to persist, and in fact they are likely to accelerate, including the rising rivalry with China and its effort to promote the international role of the yuan and the digitalization of finance. These very issues are at the center of a paper which will be published in the coming weeks and is currently being drafted by 3 leading experts who will speak at today's meeting: Arnab Das, Global Macro Strategist at Invesco; Jennifer Johnson-Kalari, Advisor at the World Gold Council; and Franco Passacantando, who is now scientific advisor at our institute, but was for many years a manager at the Italian Central Bank. They will present the main arguments of the paper and discuss other issues which are part of the broader debate over the role and impact of sanctions in the global financial system. We will then have 3 other panelists: Lorenzo Binismaghi, Honorary Professor at the University College London, who is also a scientific advisor at our institute; Zongyuan Zhou Liu, China Studies Fellow at the Council on Foreign Relations; Paola Subacchi, incoming shareholder and sovereign debt chair at Sciences Po. But before these panelists, we will have the intervention of 2 other prominent specialists: Scott Anderson, Fellow at the Governance Studies Program at the Brookings Institution, who will deliver the introductory keynote speech, and also Liv Mostri, Chief Executive Officer at the Euroclear Group, which, as you know, is the financial service provider company who is headquartered in Brussels and holds a large part of the frozen Russian assets. So I wish to thank all of you for accepting our invitation. It has been a great pleasure to interact also with you to prepare this meeting. And I have the pleasure to give the floor to Scott Anderson, Fellow at the Governance Studies at Brookings Institution, who will speak online.
Greatly appreciate the invitation. And I only wish I could be there to join you in Rome myself. Fortunately, I'm home today because I have a 2-week-old newborn baby at home who's who you may hear in the background a little bit. My wife is trying to keep her calm, so apologies for that in advance. As everyone here knows, in February 2022, Russia initiated an unprecedented and unlawful war of aggression against Ukraine that continues to this day. That same month, the United States, Europe, and various allied states responded with an equally unprecedented array of financial sanctions that, among other measures, froze more than $300 billion in Russian sovereign assets, most belonging to Russia's central bank. And now, more than 2 years later, the same allies are considering, or at least many of the same allies, are considering going one unprecedented step further and actually seizing those assets in order to transfer them to Ukraine. Today, I've been asked to give a bit of a walking tour through some of the legal issues that surround this possibility, which is still being actively debated both in Europe and the United States, while touching on some of the sanctions measures that preceded it as well, and in particular to think about how these legal questions relate to the broader phenomena of what is often called de-dollarization, the move away from a global economy centered on Western economies towards a more balkanized or fragmented economy that is the focus of today's events and a lot of the other discussions that will be taking place. To start with, on the legal front, no one should doubt that Russia has committed grave violations of international law in pursuing its invasion, in direct and unequivocal violation of Ukraine's international legal rights. And no one should doubt that Russia, as a result, has an international legal obligation to provide Ukraine with full reparations for the immense damage it has caused. Those legal matters are really not in dispute. What is missing in this formula, what is in dispute, is what international legal mechanism could be used to make Russia actually pay these reparations. No existing international tribunal or other institution has jurisdiction over the entirety of Ukraine's claims. At most, a few have jurisdiction over a small slice, or some being contemplated, for instance, at the domestic level, might be able to claim a bucket of things like war crimes. But many of these rarely issue large damages judgments of the sorts that you would need to kind of warrant or cover the full-scale damages Ukraine has suffered. The register that's been set up at The Hague, the UN General Assembly, is doing very important work in documenting all these potential claims, but it doesn't yet have any authority to issue any awards. Historically, the international community has usually set up ad hoc mechanisms for these sorts of purposes of adjudicating these different claims, either with the consent of the participating parties or the imprimatur of the UN Security Council, neither of which seem particularly likely in the present case, at least anytime soon. Indeed, past conflict reparations have almost always had to wait until a negotiated settlement at the end of a conflict. Notably, the G7 has already thrown its weight behind such a solution, as its members have agreed not to unfreeze Russia's frozen assets until it ends its hostile actions, provides full reparations to Ukraine, something that presumably Russia would not only really consider once it ended its offensive operations in Ukraine. But waiting until the present conflict is over, or new tribunals can be set up to adjudicate these claims, leaves Ukraine shouldering the immense expense of defending itself and rebuilding itself from Russia's onslaught. And this is a prospect that simply may not survive, particularly if the flow of assistance from the United States and European allies continues to dry up. Given all of these circumstances, using the frozen Russian assets to support Ukraine has a clear moral, legal, and policy appeal, but it also presents serious legal and policy challenges that need to be wrestled with if it's to be considered. Many of these are unique to the domestic laws and policies of the various countries holding these assets. I've written about this in the United States context separately. I'm sure there are similar issues in many of the other jurisdictions that are considering seizure that I'm really not qualified to talk about as a US-based lawyer and an international lawyer. But given the audience today, my comments are going to focus instead on the international and related law and related policy concerns that are shared by all the countries considering this path of seizing Russian assets. The main international legal issue at play is that central bank assets, which constitute the lion's share of those assets whose seizure is being contemplated, are among the most protected form of foreign sovereign assets under international law. They receive the highest level of sovereign immunity protections against attachment and other legal proceedings in the country's domestic courts. And while there's a legal debate over whether these sovereign immunity protections actually extend to things like non-judicial conduct, like seizures by an executive or legislative branch, international law also just generally bars the appropriation of foreign government property by a different government, and especially foreign central bank property, for reasons that can stand independently of sovereign immunity if one needs to. Generally speaking, states do not go about seizing each other's assets, and particularly don't go about seizing each other's central bank assets. And this is all in recognition of the essential economic role that central bank assets have come to play for most modern states, above and beyond other sovereign assets, which receive their own robust legal protections, but not quite to the same level. And importantly, these legal protections are widely believed to be a central part of the broader legal architecture that has allowed the US dollar and the euro to emerge and maintain their roles as the world's two leading global reserve currencies, and the United States and its European allies to become such popular hosts for foreign central bank reserves. For this reason, many worry that undermining these legal protections by seizing Russian assets could thus contribute to the process of de-dollarization that many believe is underway, as various foreign governments become fearful that their economic reliance on the West will be weaponized against them and begin to seek out alternatives, such as China's renminbi, to which Russia has increasingly turned in recent years. I'm going to come back to this question of de-dollarization a little bit towards the end after I dig into some of the legal issues to marry them together. Now, international law does present at least two possible avenues around some of these legal barriers to seizing Russian assets. The problem, though, is neither is really well established or clearly a good fit to this scenario, at least as they're presently understood. One is the doctrine of collective self-defense, which allows Ukraine to ask allied countries to aid them in acting in self-defense against Russia's military aggression. This is generally applied to the use of military force, but some have argued that this doctrine should also extend to measures other than the use of force that international law allows states to pursue against enemy states, a category that includes, by most accounts, the wartime seizure of enemy assets. While contested, there may be legal merit to these arguments. I actually think it's something worth exploring. But here they run up against a political barrier, a political reality, which is that neither the Biden administration nor European leaders are likely eager to say that they are effectively joining the war between Russia and Ukraine as a belligerent on Ukraine's side against Russia. Indeed, this is something that the Biden administration in particular has been adamant about avoiding, the suggestion the United States set war with Russia. And I don't think that's going to budge anytime soon. So I don't think this avenue actually leads anywhere, even though there may be legal merit to it. The policy barriers are simply too high. But the more promising avenue in this context is what is known as the doctrine of countermeasures, which has been most authoritatively articulated by the International Law Commission's draft articles on the responsibility of states for internationally wrongful acts. This doctrine provides that certain otherwise unlawful actions, including those that might violate sovereign immunity or certain other international legal principles, may be permissible under international law, where one state pursues them in order to try and induce another state to come back into compliance with an international legal obligation it is actively violating. To qualify as a countermeasure, however, such actions must be temporary, reversible, and proportional to the harm suffered as a result of the violation, among certain other conditions. This reflects the fact that the goal is not to punish the target of the countermeasures, but to bring them back into voluntary compliance. Once the targeted state ceases its unlawful conduct, the countermeasure is supposed to end and its consequences cease. Notably, this is why the seizure of Russian assets presents a more complex legal question than the freezing of Russian assets, which is the main mechanism that has been pursued in the economic sanctions imposed against Russia and in most economic sanctions cases. Many states, including the United States, generally argue that economic sanctions are a back form of retortion, meaning a punitive or restrictive action that is within the implementing state's discretion and that does not actually affect any international legal obligations owed to targeted states and entities. It doesn't violate any international law, so it doesn't need to be a countermeasure. Others contend, and in some cases quite credibly, I think, that this is a rosy view of financial sanctions and that there are clearly cases where sanctions do implicate other states' international legal rights. But where that arises, it is often fairly straightforward to justify these as some sort of countermeasure, in part because asset freezes are temporary and reversible. Title remains with the original owner of the assets, and as soon as the sanction restrictions are lifted, that owner can go about using its assets as it would have in any case. Perhaps for this reason, while sanctions remain controversial as a policy measure, the practice has grown and become fairly well accepted at this point, even though there's a lot of questions about what the exact international legal basis is and some controversy about certain applications. Seizures are simply harder to square with the doctrine of countermeasures, even though the latter are clearly appropriate in a situation like the present one, where Russia is engaging in an ongoing unlawful assault on Ukraine and is continuing to fail to provide Ukraine the reparations which it is clearly due. Now, the difficulty in reconciling seizures again comes back to this main issue of the fact that countermeasures are intended to serve as a voluntary form, are intended to promote the voluntary return to compliance, not to serve as a punishment. For this reason, they are, as far as possible, to quote the draft article, supposed to be reversible in the event that the targeted state returns to compliance with international legal obligations or submits to credible international dispute resolution processes. Seizure, by contrast, seems like the definition of permanent and irreversible, as the main action is to transfer irrevocable ownership rights to another party, which would stay with them regardless of Russia's future actions. Advocates for asset seizure have pointed out that this isn't an absolute requirement of the draft articles, which is true, but the exceptions the draft articles talk about are generally understood to be limited to permanent effects that are incidental to the main reversible and temporary countermeasure. it's not supposed to be the bulk of the countermeasure, let alone the entirety of the countermeasure, as is arguably the case with an overnight seizure. And there is a separate argument that the fact that a transfer might, or a seizure and transfer might help bring Russia back into compliance with the underlying international legal violation, in this case its failure to provide reparations to Ukraine, that is somewhat compelling. It's interesting, but it's a novel reading about how reversibility works in regards to the draft articles and countermeasures. It is a new view, a new take on that is not widely described to and not anticipated clearly, at least in the draft articles. Separate from this question of reversibility and temporariness, there's also a question about the extent to which countermeasures can be pursued by third-party states at all, whose international legal rights have not been directly violated by Russia's conduct, as Ukraine's clearly have been. This issue arises in the sanctions context as well, but the practice there, particularly because it's muddy about what exactly is and isn't a countermeasure, as opposed to retorsion in the first place, makes it a little bit muddier practice area. The draft articles are agnostic on this topic, quite expressly so, and legal scholars have debated them in ensuing years without coming to a clear consensus. But nonetheless, advocates for seizure have pointed to at least 3 different arguments that might be a basis for allowing third-party countermeasures of this sort. The first is the fact that the draft article suggests that states that are especially affected by a state's violation of international law can pursue countermeasures even if the obligation violated was not one strictly owed to them. This is undoubtedly a basis for pursuing countermeasures in certain cases. But using it as the basis for an massive seizure of the type being anticipated here, I think would push the concept of who is especially affected to its limits. Given the global ramifications of the Ukraine conflict, nearly any state could come to be affected in some way. And I'm not sure it's clear that Europe or the United States have been affected in a way much more dramatically than many other states of the international community, particularly when you take into account that a lot of the more severe consequences and costs those countries have taken on have been a result of their voluntary policy responses to Russia's actions. Right-minded policies, good policies, but nonetheless entirely voluntary policies that they have chosen to pursue. In this sense, if you were to say these countries were especially affected, I think you're setting the bar really quite low and saying, well, lots of states could make a claim that they're especially affected in this way. And the draft article suggests instead that this is supposed to be a very high bar, limited to circumstances where a state that is affected in a way that makes it much more severe and differentiates it from the broader community of states who may be affected to a lesser degree by a particular action. Separate from that, there's also a proportionality question, because when you're dealing with a especially affected claim, the state is implementing a countermeasure based on the degree to which it is affected by it. And so how that affects proportionality, for example, if Belgium were to use this as a basis for seizing $200 billion, when its direct effect is arguably probably much lower than that, it raises a question. You'd have to iron out how proportionality works in this context. That's not entirely clear to me. Though considerations given the gravity of the legal violation the draft articles permit could help remedy this somewhat, I think. A second argument that's somewhat similar proposes that all states may be able to pursue countermeasures for violations of foundational erga omnes obligations that are owed to the entirety of the international community, a category that is generally understood to include aggression, although there is some debate over whether it also reaches an obligation to provide reparations for aggression. That's a somewhat more contentious assertion. While not as expressly accounted for in the draft articles as the especially affected sort of avenue, this approach could avoid the tricky fact and credibility issue of the special affected approach, the bar set in question there, but it does also, I think, raise some similar questions about proportionality and implementation that would have to be ironed out. A third argument that I find a little more appealing pursues a different attack by positing that Ukraine may ask other states to pursue countermeasures on its behalf in what are often called collective countermeasures. A familiar concept from the self-defense context mentioned above, this approach has long had advocates and some support in state practice. But the ILC ultimately chose not to include it in the draft articles. Instead, they remained agnostic on the question, as I mentioned before. Some states have been hesitant to embrace this approach for fear of opening the doors too broadly to otherwise unlawful retributive action, basically facilitating self-help across the board in all sorts of cases between states that would be potentially destabilizing. Though in the present case, I actually think this approach arguably does that substantially less than would the sort of specially affected argument along the lines that I articulated above, potentially even an obvious sort of obligation. Notably, this approach also avoids proportionality question and concerns raised by the prior two approaches, as it clearly ties proportionality to the injuries suffered by Ukraine. That's the basis on which states are acting. It also sinks in better with the fact that states are providing these seized assets back to Ukraine, something that would not clearly be required under one of the prior two methods of countermeasures. Some have advocated for combining this approach with one or two of the best approaches above, basically limiting collective countermeasures to situations involving erga omnes violations, And this could be an additional hedge against the risk that you are opening the door too far to self-help measures that are stabilizing among the states, as some may be concerned. Whatever their respective merits, all of these approaches share one common characteristic. They push against the generally accepted parameters of countermeasures doctrine. This does not mean they are unlawful. All have some grounding in the draft articles and relevant state practice, even if they have not been fully accepted. And international law does evolve as states adopt new legal positions that push previously accepted boundaries. But by establishing a precedent that is likely to be emulated, relying on these arguments will lead to what is sometimes called the progressive development of law in this space. Here, that is most likely to mean space for states and their allies to engage in self-help secure compensation where they believe they have been internationally wronged to a degree greater than is currently the status quo. That may not be a bad thing depending on your perspective, but it is something implementing states need to be ready to live with. Perhaps because this prospect makes some states nervous, experts and policymakers have rolled out a number of innovative measures that try to avoid these hard choices while still providing substantial support to Ukraine by taking kind of half measures or slightly adjusted measures. Few of them actually succeed, though, on both of those fronts, at least to the same degree as proposed full-on seizure would. Some of these proposals would only seek to transfer certain revenue generated by frozen Russian assets to Ukraine, as opposed to the principal amounts, as we heard from our introductory remarks. In some cases, these amounts would be generated from profits that are being accrued by financial institutions to which Russia has no legal entitlement under existing contractual arrangements. That may be disputed and very well may be the subject of litigation, but if there's a credible argument that Russia has no claim to those proceeds and profits, then it seems like a host government probably could tax them and transfer them to Ukraine, and that would not even implicate Russia's property in any meaningful way. But if you are actually talking about interest to which Russia is entitled or the principal amounts of these funds, that actually just creates the same problem again. Those are assets that generally get international legal protections. And the same goes if you were to take those assets and were to invest them to try and generate more revenue from them, there would at least be a credible claim, I think, by Russia that it has a legal interest in the results of that property. A weaker one than interest to which it had some sort of contractual guarantee, ex ante, but nonetheless, it's going to be a disputed question. Doesn't mean these aren't worth pursuing, doesn't mean they may not be vindicated in the end, but it does raise legal questions the closer you get to interest or the principal amounts to which Russia would otherwise be entitled.
Mr. Anderson, please, you have just 2 minutes to end.
Okay, sorry, I thought I was still at 20 to 30 minutes. So I've got a fair amount more to say, but all right, let me cut this short.
Try just to summarize your final points. Yeah.
Okay, give me a minute here, let me see. A second wave of proposals that I'll talk about very briefly would use various mechanisms to allow Ukraine to effectively use frozen Russian assets as collateral to secure loans. There's a lot of different ways you can structure this. This will allow Ukraine to secure assistance in the form of loans in the short term, but would essentially kick the question of whether you have to seize assets down the road to the point where Ukraine may not be able to repay its loans, and then at that point you would have to try and get those seized assets as collateral. There's a lot to be said for this approach. Like, it's useful to kick that can down the road, but it doesn't solve the underlying legal questions in the long run. It just maybe helps you avoid them or delay that final resolution. So I have a lot more to say about the ways to approach and juggle these sorts of interests, but it sounds like my time is up. So let me just circle back to this de-dollarization question. How does this all affect de-dollarization? De-dollarization relates to this because of the perception that if states are acting unlawfully and arbitrarily and seizing assets becomes prevalent, that is going to create a lot more incentive for de-dollarization. How marginal that will be, how big a difference that is on top of the incentives already provided by the broad sanctions pursued by countries, it is a fair question to ask. But seizure is psychologically different. It doesn't have as much established practice. It's a much bigger step, and I suspect it will create greater incentives. Now, those incentives may not be able to be acted upon. There may be a lot of other constraining factors that limit the extent to which foreign governments can move away from Western economies, but the incentive is still there. And for that reason, I think it is worth states thinking about if they want to pursue seizing Russian assets to benefit Ukraine. And there may be very good policy arguments to say that's worth doing in spite of the cost of marginal de-dollarization effects. They should take steps to limit the impact that whatever legal precedent they are establishing has on the legal protections and parameters that apply to all the other foreign governments' assets. Essentially, they need to strike a legal argument that is narrowly tailored as possible to Russia and Russia's conduct in these unique circumstances, and that does not purport to open the door open to seizure or other actions that affect lots of other states. I have some suggestions on how to do so, but that was the main content of the remainder of my remarks, so I will cede that to the moderator, but happy to return to that in questions and answers or at a later moment where time might allow. Thank you.
So many thanks for this comprehensive, very insightful overview of the challenges that the Western countries are facing in considering additional sanctions or punitive measures against Russia. Let me just say to our online participants that they can post their questions at any time, and then we will have, as announced, a final Q&A session at the end of the second panel. So it's my pleasure now to give the floor to Liv Mostrich, Chief Executive Officer at the Euroclear Group. Again, the Euroclear Group is the financial services company. It is a Belgian company based in Brussels, which holds, I think I can say, the large part of the Russian frozen assets in Europe. Please, you have the floor.
Thank you. Thank you. Good afternoon, ladies and gentlemen. I will try to explain 3 topics to you. I will start by explaining a bit what Euroclear does, what is our role in the financial ecosystem. Then secondly, I will try to explain how we have come involved in this situation and why and how all the mechanics that have led to the situation where indeed we are the major party holding these Russian assets. And then in the third part, I will explain a bit how we look at some of these legal analysis of all of these options of using either the profits or the principle of Russian assets for the support of Ukraine. So Euroclear is a financial market infrastructure that has been created around 55 years ago in Belgium, in Brussels. And what we do is that we are a kind of notary or bookkeeper or registrar for securities-related transactions in the markets. So we ensure that parties selling their securities are certain to get their cash, and the parties that are paying for securities, giving the cash, are certain that they get the securities. We safekeep those securities for all professional actors in the market, and we also allow them to mobilize those securities for anything that has to do with collateral transactions, that has to do with secured financing, that has to do with tri-party deals and the likes. Doing so, at this stage, as a group, we safeguard around 39 trillion euros worth of securities across the globe. And the transactions that we process over our books are on a yearly basis worth about €1 quadrillion. That equals world GDP every month over our books. So to give you a sense of the importance. Why were we created in Belgium? I think it is a nice point to just touch upon. It is because the legal framework in Belgium on asset protection, on prohibition of attachment, has been considered the strongest in the world, and that is why 55 years ago, at the initiative of JP Morgan and a number of other international financial institutions, Euroclear was created in Belgium. On top of that asset protection, we have a bank that has a limited purpose license. I will come back to that because that has a number of consequences that link immediately to the file we are discussing. And we also do everything from a capital perspective, from a risk management perspective, to preserve our AA rating. That AA rating is also very important because it means that for central banks, the combination of the legal framework in Belgium, having this limited purpose bank with a AA rating, makes that Euroclear has become one of the safest places where central banks can deposit their securities that they use for their reserve operations. So this means, as Euroclear, that our main source of revenues is really fee income. We are being paid for all the services that we deliver to our clients on settling those transactions, on safekeeping them, on facilitating the collateral management transactions. And we used to say that we have a bit of interest income that we consider the cherry on the cake in our revenue base because of the accidental cash balances that our clients leave with us in between doing the transactions. However, our limited purpose license really requires from us to limit those balances, as our regulators consider the reinvestment risk of such cash balances one of the biggest risks that we would incur, and therefore that we have to minimize. And in that context, in order to minimize that risk, we have put in place a number of incentives for our clients that really push them to take out cash from ourselves. The biggest incentive being that we don't pay interest to them, and if we are in a negative interest rate environment, that we even apply more punitive negative rates than central banks in the different currencies would do. So this is a bit setting the scene around Euroclear. We are with that a company that last year made close to 1 billion net profit on those fees and on this accidental interest income on these accidental balances from our normal activities. Now, what have we done in the context of that business offering? We have also seen that it was very valuable if we would be connecting international investors to issuers in emerging markets. For the emerging markets, this was very attractive as becoming Euroclearable, being connected over the Euroclear system, really meant that they could increase substantially the foreign direct investment that they would have, and they could do their governance funding at a substantially lower cost. And so over the past decades, we have worked with several countries to connect them over what we have called our Global Reach product. And we have done so with a number of South American countries. We have done so in the past with, in the more recent past, with the Arabic Emirates. Saudi Arabia is linked in that way. We are working with South Korea. And we have even seen that sometimes countries claim that they were on the path to Euroclearability just in order to get a better relation with the IMF and support of IMF. So this is the context. And now this global reach product, disconnecting emerging markets, is something that we have done about 12 years ago also with Russia. We should remember that about 12 years ago, Russia was a very investable market, and there was a lot of demand from international investors to be able to invest in Russia in the safest possible way over the Euroclear system using a Euroclearable link. And this is something that we have established at that moment. Having done so, this means that a big part of international investments in Russia happen over the books of Euroclear. And so a lot of issuances that were done from the Russian government, from some municipalities, from some Russian corporates, when they were invested in by international investors, that was happening over the books of Euroclear. And vice versa, because when we create a Euroclearable link, that requires a lot of work with local authorities, with ministries of finance, with the central banks, because it requires to make sure that the local laws in those countries have a sound asset protection, have sound tax systems, etc. And so we had established, as we do in every country that we make euro clearable, a very strong relationship with the local Ministry of Finance, with the local Central Securities Depository, with the local central bank as well. And so as a result of those good relationships, we have also seen that when Russian parties wanted to invest internationally, it was for them a logical route to use the Euroclear as their way for investing internationally. And so this means that at the moment when the sanctions were declared very shortly after the invasion in Ukraine, we were immediately very much aware that this would have a huge impact on ourselves in both directions, Western investment in Russia as much as Russian investments in the West. And we have taken immediately the strong strategic intent that our big focus would be on protecting the risks for the company as a consequence of this, and I will dwell a bit more in that later, and that we were also going to give full transparency on this. So we know that European Commission has demanded more transparency and separate reporting, but I like, and I take proud of that, that as of the first quarter of 2022, we have on a voluntary basis immediately separated out balance sheet data, P&L data of Euroclear to separate out all consequences from that Russian situation. And we have also, on a voluntary basis, immediately taken the decision that we would not pay out any of these profits towards our shareholders. Let me explain why we make profits on that. When the securities are in securities accounts, these are off balance sheet, and these are the property of the client, and all coupon payments remain the property of the client. However, when securities come to their end date and they redeem, the securities go off balance sheet away, and they become cash on balance sheet of our limited purpose bank. And so what we have seen is over the period, we have seen that especially Central Bank of Russia's investments were pretty short dated. And so we have already seen a lot of those securities that have transformed in cash in different currencies. The bulk is in euros, but there's also a bit of dollar, a bit of UK pounds, a bit of Canadian dollars. We have a bit of everything, but more than 60% is euros. And so, as I have said, we pay no interest towards our clients. We pay no interest to sanctioned clients either, but we need to reinvest the cash that comes available at the cash correspondence, and we need to reinvest that in the safest possible way, which means that we look for a maximum of redeposit with central banks. Now, in the same period of time, the interest rate environment has totally changed. Had we stayed in previous interest rate environments, this would not have yielded profits for Euroclear, but in this environment, this has very rapidly yielded profits, and I can be very transparent on that. The Russian-related activity over the course of 2023 has yielded gross profits that are mostly interest rate related around 4.3 billion euros, net profits around 3.2 billion euros, which we set aside. But it is clear towards all legal advisors that we have and our accountants that those profits are Euroclear profits, and that's the reason also why we have to pay corporate tax on it, which is in Belgium 25%. That's the difference between gross profit and net profit. Now, how do we look at these initiatives that could try to use that money for the benefit of Ukraine? So first of all, I want to stress that our legal analysis does not look at the international legal framework that could justify any action on that. What we find very important is, what I said initially, this protection of the company. We have to understand that as a company, the consequences of these actions do not create huge risks for us. We are already aware that capital rules that change will have as an effect that we will need to mobilize at least 2 billion more of capital because the capital rules will change and will take the revenue top line as the first multiplier to determine operational risk-related capital, and that will include these Russian revenues, and that will have this huge impact. If we look at the windfall contribution, as said, the steps 1 and 2 of the European Commission initiative are things that we have been doing already on a voluntary basis. We know that as of the 15th of February, we will be due to have to pay a contribution towards the European Commission, of which the exact size still has to be decided. And if we look at everything that has to do, be it seizing, but frankly, the collateral is a bit in the same area, and the potential thinking of monetizing the profits to make it a bigger amount that can go faster to Ukraine, sometimes called front-loading. Our biggest concerns are that it is not because an international legal framework says that that can be done, that the Central Bank of Russia, in its contractual relationship with Euroclear, would not no longer consider the liability that we have towards them as being valid. So the biggest risk that we always mention when we talk about these kind of things is the risk of double claim. That is where seizing has happened or the encumbrance of the assets because of the use as collateral. So because of these facts, we would not have the same strength against the liability that would remain towards the Central Bank of Russia. And that is for us the biggest risk. And within 5, 10 or 15 years, we don't know when, but at one point in time, Russia might become again a friendly party, and the sanctions may become lifted, and they can come and knock on the door of Euroclear and say, you still have a liability against us, and we want that money back, which would have been taken away from other sources. So this double claim risk, and it's not a theoretical risk. We have not yet suffered from it, but we are well aware of a case in the context of Iranian sanctions, where a colleague of ourselves, a competitor of ourselves, is being in court exposed to that double claim. And it could even be worse than what I say, because the Russian Central Bank could not only go and try to claim in Belgium, they could not only go and try to claim in G7 countries, or in Russia, the first place is Russia, but they can also go in any country that is closer to them on a political alignment, but where we hold for our international clients assets locally. And they could go and try to convince, in whatever of such countries, a local judge of saying my property rights have been mistreated, please give me just compensation, and the just compensation could be the assets that are under Euroclear's name in almost any country, and we hold assets in about 50 countries. So I will stop it here in order to stay in the timing, but I'm certain that we can come back to questions later on.
Many thanks. I'm sure that then in the QA session there will be further opportunity to discuss more specific issues. Now I have the pleasure to pass the chair to Federico Fubini, who is a very well-known columnist at the Corriere della Sera, which is the Italy's newspaper with the largest reading. So, Federico, please.
Thank you very much, and thank you both for the enlightening presentations. Already, they would raise questions, for instance, as to the ownership of the revenue stream and also the possibility of future double claims on the revenue streams. But maybe we will discuss this in the Q&A. We have a fascinating presentation by Mr. Passacantando, and I will give you the floor directly, please.
Thank you. So, thanks for everybody. We call this presentation the weaponization of money and the risk of global financial fragmentation. So first thing that I will say is to explain why this title and explain these two words, weaponization and fragmentation. Why weaponization? Okay, we found that this quote from the governor of the Bank of Italy is the best, perhaps, explanation of why we use the word weaponization. He said that the issuer of a global currency can use its financial power to influence international developments. This power must be used wisely, however, because international relations are part of a repeated game. Weaponizing a currency inevitably reduces its attractiveness and encourages the emergence of alternatives. So our work and the presentation that we'll make will focus exactly on this, whether the fact that currencies have been used as a weapon is actually creating already alternatives, and whether this will lead to fragmentation. So, second clarification is the word fragmentation. You know what? We have been always discussing the U.S. privilege, exorbitant privilege, that they are the only one issuing international currency. What's wrong with have a multipolar system with other countries having this exorbitant privilege? Well, what we are talking here is not just a multipolarity, which means having several currencies which can be used as international currency within the common framework and mechanisms to dialogue or to be exchanged among cells with common market infrastructure. So that is a complicated world, but is a world that is feasible. And the fact that we have now two main currencies, one the US and second, a bit less, substantially less, the euro, but have been coexisting each other. So what we mean is a fragmentation. Fragmentation would be a situation, a global situation in which the different sectors, different economic areas develop their own system that do not dialogue with the others. So it's a segmented world in which investment with investment restriction and separate payment systems in which they do not, in jargon we call it, they're not interoperable, but basically they do not write to each other. So we will look at that. There's not just multipolarity, which could be even interesting and positive. Having said this, let me see if Jennifer appears.
Thank you, Franco. Are you able to hear me?
Yes.
Okay. First of all, thank you, Franco, for the introduction, and also to the Institute for International Affairs for having organized this conference. In the next few minutes, I'd like to open by touching on the definition and role of central bank foreign currency reserves, and recent developments in the gold market. So just at a high level, foreign currency reserves are a linchpin of the international financial order, necessary for mitigating shocks, smoothing global imbalances, and reducing systemic risks. And as such, as Scott noted earlier, they have been granted a higher level of supplementary court attachment, which is greater than that enjoyed by states. In abstract, foreign currency reserves represent national savings held either in foreign currency claims on foreign entities or in gold, so that they are not susceptible to domestic troubles. Qualify as reserves, the IMF requires that the financial assets be denominated in foreign currency and represent claims on non-residents. In practice, central banks have held both their financial assets and a large part of their gold in extraterritorial depositories. The criteria used by central banks in placing their national savings with foreign entities are safety and liquidity, the ability to access reserves in times of domestic stress. Traditionally, central banks considered mainly the risk of repayment and liquidity in deciding their currency and asset allocation. But with the Russian sanctions, big politics have entered the calculus. Before moving on, I just wanted to note that today's system has not been the historic norm. Only twice in Western financial history have states entrusted their savings to fiat currencies of foreign countries. I believe the first was in the 17th century, and then in the last 50 years with the dollar. Recent movements in gold point to increased central bank interest in accumulating an asset that is nobody's liability alongside its foreign currency financial claims. The first graph on the left-hand side shows the net accumulation of gold by central banks over the last 25 years, and this we've divided by the advanced economies that you see in red on the bottom and emerging market economies on the top. Until the shock of the great financial crisis in 2007, the reserve issuing countries, the advanced economies, had been steadily divesting of gold stocks under the London Gold Agreement as the world coalesced around the US Treasury as the risk-free asset at the center of the international financial system. The global financial crisis was marked by dollar shortage as well as a decline in the confidence in Western financial institutions. And this was reflected first in de-risking, but also in the accumulation of gold by emerging market countries, dominated by Russia, China, Turkey, and India. I'd like to draw your attention to the second chart, which illustrates the purchases of gold by central banks over the last 2 years since the announcement of sanctions on Russia reserves. And these bars represent not only those purchases that have been reported to the IMF, but also those that have been as yet unreported. The case of Russia and its de-dollarization is well known, and you can see that in the yellow bars, whereby it started divesting of US dollars in 2014 and reallocating the proceeds to euro, renminbi, and gold. And you can see that from the advent of the invasion of Eastern Europe through to the Russian sanctions when Russia data what became less available. In the case of China, following sanctions, China divested of about $230 billion in US treasuries, and the proceeds of that appear to be allocated to both reported and unreported gold purchases over the last 2 years. For many of you in the press, you will have seen that central banks' buying has been reported at around 1,000 tons over the last 2 years. But if you add on to that the unreported buying, which is attributed mainly to China, the numbers are more than 2.5 that, and would represent in dollars about a couple $100 billion in unreported gold purchases. This central banks have attributed the rationale for accumulating gold to domestic reasons, to its characteristics as a portfolio diversifier, but since the war in the Ukraine, the rationale for more recent purchases has centered on heightened geopolitical risks and, at least in the case of Russia and China, de-dollarization, though we have not seen that more widely. While a solid store of value, gold, however, has its limitations in terms of central bank market interventions. So I'm going to hand over the presentation to Arnaud Daz, who will discuss the predominance yet today of the US dollar in terms of its share of currency reserves, but leave you with the thought that accumulating gold as a hedge against geopolitical risk and potential fragmentation. So Arnaud, over to you.
Just to try and put some numbers and pictures around the structure of the international monetary system, the payment system, and international reserves and transactions by currencies, okay? And then turn it back over to Franco to talk about some more about changes in the international infrastructure. Okay, so can we go back to the slide? Okay, so this chart shows you the evolution of international reserves by the currency of the issuer, right? And so in green here, which is the largest share, you have the dollar, represents about 70%, somewhere between 60 and 70% of dollars of reserves in the world are in dollars. The dark blue is the euro, somewhere between 15 and 20%. And if you add up all the Western currencies that are in reserves, you get to something close to 90%. Okay, so the international financial system, when it comes to the stock of reserves, is dominated by Western fiat reserve currencies. Okay, China and some other countries are making significant inroads into that stock of reserves, but the share is still very low, right? And it's not rising very fast, but it is definitively rising. So China is in the red there, and you can see that that represents something around 3 to 4% of international reserves by value. Okay. This slide shows you the composition of the holdings of reserves, right? So it's the other side. Who holds these mainly Western reserve currencies? And so the chart on the left-hand side shows you the evolution of that over time. Over the last, since the turn of the century, if you like. And the chart on the right-hand side shows you the distribution by category of country with the latest data. Okay, and so the message here is that the reserves are roughly split, more or less evenly, between what you might call allies and friends of the United States and what some people think of as countries that are already adversaries, right? And so they're arranged in the bar chart on the right-hand side, roughly by geopolitical and to some extent geographic distance from the United States. So the left-hand bar is advanced countries, high-income countries, mainly in the Western world, and Japan, Korea, and really all of them, with the exception of Taiwan, which is listed there separately. And what you can see is that the advanced countries and China have roughly the same share. This is Greater China, that includes the Hong Kong and Macau special administrative regions, which are formerly part of China, right? But Taiwan, which is A province of China, but is an independent country, is listed separately as having something around 5% of international reserves. And you can see also India and some other countries, the Gulf states have around 5, a little north of 5. I should say the Gulf states here excludes Iran, okay? The chart on the left-hand side shows you that this split has been roughly constant over time between friends and allies of the US and potential adversaries. And of course, Russia is there as well. It's something like 4% of global reserves that are now blocked in Euroclear, as we've discussed. Okay, now the following charts show you something about, and this map, about the structure of financial transactions in the world by currency. Franco used the term multipolar before, and I would say, you know, we could think of the current distribution of financial activity by currency as multipolar rather than fragmented, right? Several currencies are being used in the same framework, but it is very clear that at least until the war began, the United States dominated this area too, right? So the maps show you by shading the share of transactions geographically that are taking place in the dollar, in the euro, the renminbi, and the yen.
Sorry, this refers to 2022?
2021, pre-war.
Okay.
It's the latest full data we have easily available. So pre-war, and of course the war began in the beginning of 2022, as everyone knows, and then things started to change, and we'll come to that in a moment. So the dollar is being used by many countries, right? It's being used, of course, by the United States in its own trade transactions, but it's also being used by third countries to trade with each other. That is happening to some extent with the euro and the yen and the renminbi, but I think it's fair to say that most of the use of the euro, the renminbi, and the yen is regional, and it's mostly, not entirely, but mostly being used by those countries, or in the case of the Eurozone, that region, to do its own trade, right? It's not entirely the case, but it's mostly the case. So the dollar is the main global currency that's being used by almost everyone. That was the state of affairs, at least until 2021. It continues to be substantially the state of affairs, but it is starting to change. So the next two charts show you what is happening in the movement around transactions around the world. This chart shows you SWIFT, the Society for Worldwide International Financial Transaction, or Telecommunications, a messaging system which facilitates these transactions, right? And you can see that Western fiat reserve currencies in the green bar on the axis on the right-hand side still dominate the flow of activity through SWIFT at something like 80%. But there is a noticeable decline, right? It's gone from something closer to 90% down to 80%. A large part of that difference is now being made up, even within SWIFT, by the renminbi, right? It's not just the renminbi, but that's the biggest mover. There are some others, but that is what is happening, right? The dollar, the euro, the yen, the pound sterling are losing some market share, and the renminbi is gaining some market share in SWIFT.
This 10% difference, is this 10% difference all about Russia or other countries as well? What do you think?
It's partly about Russia, okay, but it's not just about Russia. Okay. It is, you know, what is happening, I think, is that in...
Actually, I think it's important to point out that this data excludes trade with Russia, because they are off SWIFT.
Yes,
So,
since 2022,
so
it
this
excludes...
underestimates.
Yes. So, but the rise of the renminbi is still partly about Russia, and this is the point about the risk of fragmentation or balkanization, as Scott called it at the beginning of the proceedings today. And that, I think, is what we come to in this chart here, which, as Jennifer points out, Russia has been, since 2022, excluded from SWIFT, but China's trade seems to be moving substantially off SWIFT and out of the Western financial system, at least to some extent, onto its own cross-border payment system, as it's called, CIPS, China's cross-border payment system, and that's what you see here. The red bars are payments that China is making across the border through that system. The green bar is receipts that it is getting for its exports. And the blue line is transactions. So you can see that this has been rising over time and has substantially accelerated since the war and the sanctions. And this does include the trade that China famously does with Russia now in oil, which is being settled in renminbi. Of course, there are other things going on. You know, China is not the only country trading oil with Russia in currencies other than the dollar. India is doing so, mostly it would seem, in Indian rupees. So there are other things going on, but the main difference that is taking place in the international financial system, because of the sanctions, because of the conflict, and because of this desire that many countries have to protect their financial activity and economic activity from sanctions, is that the system is at some risk of becoming fragmented and balkanized rather than simply multipolar, right? That's what's at risk here. So I will stop there and hand it back over to Franco to discuss.
Yes, thank you. Let's summarize where we are before we finish. So basically, the most common view is that, you know, the one who really are trying to push for even seizing the Russian reserves is that if the freezing has not produced any major impact on the allocation of reserves, so why are Europeans so worried about that? Why are so worried about the euro? Okay, we saw that this is only partially true. It's true that if you look at stocks, there's not been a big change from the dollar to other currencies. The only major change in the reserves is gold. Gold has had an incredible growth, especially because of central bank purchases. But however, gold cannot become a reserve. I mean, gold is illiquid. The gold is scarce. There's not much gold around, so it can never substitute for exchange reserves. Having said that, besides gold, what we see is the increase, and this is the last chart that was being shown. The actual increase, not of the stocks, but of the use of different currencies in payments. So if you forget how much, whether the dollar is losing in terms of relevance for exchange, that's not much. But if you see in certain transactions how the dollar is losing, the euro is losing, and the other currencies are increasing, there is a clear sign. The yuan, the renminbi, we never know how to call it, but I mean the renminbi is definitely growing, which means that both the euro and the dollar are decreasing. So what is the strategy that, especially we focus of course on China because China is the main alternative, that China is using to promote the renminbi? First of all, financial incentives. China gives what is called the swap has created swap arrangements with other central banks, which means that it provides renminbi to other central banks under an agreement that renminbi will be returned in few months, which means that other central banks can in turn finance their own banking system in renminbi. So a country in Malaysia, a country in India, a bank in Malaysia, a bank in India can finance its customers in renminbi because it has the renminbi provided by the Central Bank of China. So that is the first. Second, a lot of, is starting giving loans in renminbi, and when you provide loans in renminbi, you create a liability in renminbi, and then you create a demand for that asset. Now, this trend is also very much politicized. Definitely, China is using the Belt and Road Initiative countries to push for loans in renminbi, is using also the BRICS now countries. So there is a lot also of, we see a lot of politicization in the use of the renminbi, not just for economic matters, but also for technical, not just for technical matters, but for political matters. And this has always happened, as we know, in history, you know, that the changes in the monetary system have always had a political, military, and strategic dimension. Now, the second big change that is happening, and we are just starting to see, is the use of new technologies. Fintech, digitalization, and this is important because when we talk about the dollarization, we think a world where the dollar will be less important and other currencies will be more important. But there is also an alternative approach which sees that simply the Western dominating transaction system will lose traction on many countries, and these countries will use other more or less transparent mechanisms. We all know Bitcoins, we all know, I mean, Bitcoins is an exaggeration, it's not yet used, but in some financial transactions it is used, Bitcoins. There are fintech initiatives that circumvent the traditional payment system. So you can have a less transparent system of payments, which could also reduce the capacity to impose sanctions. And plus, there is the whole world, we cannot enter into that because of lack of time, of digital currencies, of launch of new digital initiatives. We could also make attractive the Chinese currency and other currencies. So what we want to reach the conclusion asking the question, but has weaponization really created alternatives? Well, of course, it's very difficult to predict what will happen if there will be a seizing of reserves. But also, as Scott Anderson said, certain seizures has a much different psychological impact than simply freezing. So there is, and since we have seen that a lot of these payment networks are being used because of political motivations, not just technical, we can think that that could be further expanded. So, and again, it's not just bipolar, but multipolar. We see that, you know, we talk about, for instance, the group of BRICS. BRICS are very divided in themselves. You know, BRICS, it's hard to think that they will become a union. India has its own history of leader of origin non-aligned movement. It's hard to believe that they can form an alliance, but they're still in between. And so is Saudi Arabia, and so are many other countries that are we call them swing states. They can be part either still in the West, but they can move to the East easily. So the risk that there can be a multipolar segmentation is there. And I tried not to use analogies, but I cannot resist making one. So the question is weaponization of money going to create a fragmented system? So weaponization is a way to inflict pain on a state. The consequence can be fragmentation. It's like in warfare, weaponization, the states that are attacked create trenches, and so trenches separates them and reduces the capacity of the offender to inflict pain. The difference between military trenches and financial trenches is that once the war is over, the trenches are not used anymore. I mean, you can go to the Dolomites, or you can go in Belgium and see as a tourist site the old trenches Once you have fragmented the financial system and the war is over, the financial system remains fragmented. Most likely you have to fragment it into different camps. And so one last word, is this picture so bleak? Well, not yet. We have seen that China is developing its own SIPs, but is still collaborating with SWIFT very much. SIPs uses the standards of SWIFT, so China is developing an alternative, but it still has all the incentives that its banks use also SWIFT or use SIPs with the same standards. China is also still very collaborative with major financial infrastructure, even Euroclear, as Liv mentioned, which is a crucial financial institution for central banks all over the world. China is the fourth largest shareholders of Euroclear and is still a big client of Euroclear. So the global attitude, the globalization of these countries is still there. So hopefully we can still find, and this we would have to go back to Scott's remarks on a possible solution in the area of new international law that would preserve this international collaborative approach. And I stop here. Thank you.
Thank you. Thank you very much. It's such a rich and fascinating paper with plenty of implications. So before I give the floor to our discussants, just three very quick remarks. First of all, I could not help to think that, okay, we can make a distinction between freezing and seizing the money, but it was a brutal action anyway. I can't remember of a precedent of freezing $300 billion, and I think no one, at least no one in Russia and in emerging countries, really believes that this money will be returned, because there will be reparations, there will be probably some international statement that allow those claims from Ukraine to be considered legitimate. So we can make a legal distinction, but really, are we really so sure that there is such a deep difference between freezing and seizing from this point of view? And linked to that, I thought one of the very interesting charts that you have is that, in fact, the market share of the euro as an international reserve currency is unchanged, really, if not slightly grown over the last couple of years. What has grown is the preference of central banks in emerging countries for gold as a way to store new surpluses. So they haven't liquidated the euro or the dollar, and I think the euro is really the main suspect here for obvious reasons that were openly explained. That it's really the recycling of the new surpluses. And last remark about China. I mean, for all the angst we can have and war or no war, I don't think we can possibly expect that a country with 18% of world GDP would not make moves to have its currency among the reserve currencies. It's just, I mean, why we in Italy, with the history of the lira, we want to have a claim to have a reserve currency and not China. So I don't think this is concerning per se. And okay, but I would stop here and give the floor to our discussants, and starting with Lorenzo Binismaghi. Please, you have the floor.
Well, thank you very much. The role of the discussant is in general to challenge. So I will try to challenge the theory, which is that well, sanctions may lead to fragmentation and create incentives to develop alternative financial system that in the end may be a weakening of the integrity of the system and may be more costly. Why? And the opposite would be that, in fact, the sanction regime, in fact, will strengthen the role of the dollar. That is the alternative hypothesis. And if one tries to follow this alternative hypothesis, what argument would one make? First, the role of international currency is, or achieving a status of international currency is something that depends not only on the attractiveness for the others, but on the existence of a whole system that is based on aggregation theory. That is, the more people use it, the more we use it. So there is a network element. Then you can try to grow an alternative to that, as maybe the Europeans have tried. And in fact, if we look at the distribution, you see that the dollar has still a big chunk. And the only alternative which has emerged over the last 30 years is really the euro. The others have remained very, very small. So what happens if you start having sanctions is that you, in fact, you increase the costs of, you increase the incentive to create, say, this network that is sufficiently large. But this network is not only dependent on what central banks do. Actually, if you look at the US, they don't have foreign exchange reserves because they are a reserve. Actually, if you are a reserve currency, your central bank should not have reserves. So I would say first, looking at foreign exchange reserves is not necessarily a good indicator of the role that a central bank, that a currency has. I would look more at other indicators such as, the use in payments and the size, actually, of the payment. But when you have sanctions, you have also a threat to the incumbent. And the key question is, the threat, is it bigger for the dollar or for the euro? It depends on the willingness of the Europeans to defend their own system as the own financial system as an attractive currency, but as an attractive system compared to the US. And here what we could see, and this is a hypothesis, that the US is much more determined to defend their own system than the Europeans. And this will lead, according to this hypothesis, the US dollar to remain more or less unchanged. There will be some local adjustments, these have been very marginal, to the Chinese and some others, and the European will decline. Why is that? Because to have an international currency, you need to have a system. You need to have a financial system first, which is very attractive. You need to have a banking system, which is very attractive, that builds you need to have a legal system that is very attractive. You need to have very good lawyers that help you to go around the sanctions. And we know that the system of sanctions that the US has put, typically you would go to US lawyers to help you understand the legal system and go around the sanctions. It's rating agencies, it's rules, it's a Department of Justice. So it's a whole system. And you have to believe that this system, the financial system, is part of the strength of your economy. And I believe that, I think the US has clearly in mind this issue. The Europeans don't have this in mind. And they are not ready to do what it takes to defend this. We see this in the discussions on capital market unions, on removal of certain rigidities within the system, the banking union, and we see how over time, and we can take many examples, the IRA is one, and the incentives for European companies to delist, and I mean to go and list in the US rather than Europe. I think this is going to be a very interesting indicator of the role that the US give to maintaining this exorbitant privilege and the fact that Europeans are willing or not to create an alternative. The history of the international role of the euro, of course, has been a big debate in Europe. Traditionally, the German view prevailed that it should be a demand-driven. So it should be the result of the rest of the world demanding the euro and not a supply push. There should be no incentive, which is a very naive attitude because, as I mentioned, the international role of a currency depends on the system that you have behind, starting with the supply of assets. Of course, the US has the US Treasury bonds and all the bills and all the yield curve. In Europe, we don't have this. This is just to start. The only safe asset is central bank money since the start of the euro. And as I mentioned before, the capital market, the liquidity and all this. And there is no interest in Europe to have this. We see how long it has taken to. So my hypothesis to challenge yours is that in the end of all these sanctions, and of course I didn't mention China, but China does not have the willingness to have a convertible currency because that is the other issue. You need to have free capital movement, convertible currency, and I'm not talking about the legal system, the international dimension. So it will have a share of the pie which corresponds just to bilateral trade with China, and it will grow because bilateral trade with China will grow, but it will not become something that will be used in the trade between Brazil and India, to say, as the dollar is today. So the exorbitant privilege, I mean the use of sanctions and the ability to manage sanctions in an intelligent way stop me when my time is over, because, but I think may lead to the perverse result that it will strengthen the hegemony of the dollar because of the weakness of Europe, I think, and because of the unpreparedness of China to stand by the rules of the game, which is that in order to be accepted internationally, you have to have a whole system, legal, financial, banking, and so on and so forth, which is able to compete. So you have to accept free competition. And I think China and the current Chinese leadership has different objectives, I think, which are more protective rather than putting the system at work to compete in the global market. So I think we need to test these different hypotheses. You showed me in a chart. In the chart you showed, you have the European currencies, European and US currencies together. That's green line. But if you disaggregate this green line between US dollar and European and euro, I understand that the euro is collapsing and the dollar is going up, which would tend to show that I may have some elements to support the alternative hypothesis that in the end the Americans will win. Of course, unless Europeans get their act together, which it's also a hypothesis that should not be totally discarded, I would say.
Thank you. Indeed, it would be interesting to see this graph as disaggregated, but maybe there is no time this afternoon, just an invitation, and do share the graph with us if and when you have it. I would give the floor to Paola Subacchi, who will have to leave us a little bit in advance. So, Paola, you have the floor.
Yes, thank you, Federico, thank you everyone. Very interesting paper. I will actually try to be brief in that, or will be brief in my remarks. It seems to me, as I said to Frank already, that there are two main strands in this paper, and one is the story about China and what that China is doing to internationalize the renminbi, and the other one is the incentives that sanctions can give to perhaps create something different, and not a different system, but maybe some fragmentation in the current system. First of all, I think we are, Franco and co-authors, I think you are reading too much in the data, particularly in the SWIFT data. China started to internationalize its currency under constraints, and the constraint that is Maggie illustrated very well, that it is like it's a currency that cannot be fully convertible. It cannot be fully convertible because the Chinese financial system cannot withstand capital movement. So this is actually has the central bank of China that defines this as managed convertibility. So they started in 2010 to internationalize their currency in recognition to the fact that the second largest economy in the world didn't and doesn't have a fully fledged international currency, which means a currency that can be used in trade to settle and invoice international trade, but it can also use as an asset. This really is an anomaly. We never had that in history. Then one of the largest economies didn't have an international currency. So the process, and is a policy-driven process that the Chinese central bank put in place starting 2010, is actually to push the use of the renminbi in international trade, in bilateral trade between China and its partner, because before it was all about dollars. And so the figures that you see in trade is very much reflect this trade, this development. Now, China, the bilateral trade of China settled in renminbi is now about 30%. It was basically around 1% 10 years ago, 12 years ago. So, big jump. The official FX reserve, I give you recent data. China sits on $3.3 trillion. So China has a dollar problems, and they always had it. And this comes from the decision made by the central bank to manage the exchange rate and to sterilize the inflows of capital that came from the surplus that came from trade. So it's 3.3 trillion. It's an enormous amount of dollars. Obviously, China has been trying to diversify this, and that explains why there are some purchases of gold, and also, but there is again the way to diversify is very limited. It's either US Treasury, or is euro-denominated assets, or it's gold, or something else, but on the margins. So that's point number one. And so it's not like China is deliberately accumulating this reserve. This is actually an accident, if you like, of history and economic policies. Now, the problem is to reduce these reserves that have already come down. They already come down from the 4 trillion of 10 years ago. Along with the thing, it's absolutely true what Franco said, that China lent in dollars. The amount of renminbi, lending in renminbi, is tiny. And again, at the moment, China's total external loan position is about $2.4 trillion, to which we can add another $400 billion in portfolio investment debt security. So it's an enormous amount. And again, you can see now a small but consistent trend towards using more renminbi in lending. But again, the renminbi is a currency that has limited liquidity and usability around the world, and is definitely not an asset. So that is something that China has been doing, and it shouldn't be surprising that is trying to push is international currency. Now, the issue about sanctions, again, swap arrangements. Yeah, China has a lot of swap arrangements with central banks around the world. These, again, are a function of trade, is to create liquidity to support trade with China, as well as there are many loans that are given to export, as you know, export credits. The Russian central bank used the swap, the RMB swap, in a couple of occasions after Crimea and after Ukraine. But again, we talk about $30 billion, again, $500 billion reserves that were put under sanctions. So these are incredibly important arrangements, but they are tiny arrangements compared to the bilateral swap arrangements that the Fed has with the main central banks. And the Fed swap arrangements are typically an instrument, a financial safety net. So that's the thing. Having said that, China has another problem. And I was in China last week, 2 weeks ago, and actually the discussion was all about how they can diversify their position and to be less dollar dependent. And the big way forward, again, is to have a more international currency. Where China has a lead is in central bank digital currencies. And the e-yuan is already a reality, is widely used inside China. And there are some experiments and bridge with central banks in the region to use the e-yuan to settle trade in the region. So that could create, if it's not properly regulated and if there is not, let's say, policy cooperation around digital currency, that could create not a different system, but a fragmentation within the current system. And this is an area where China has clearly a lead compared to the United States. My final point is, again, about the weaponization of the dollar. I totally agree with Scott and the other interventions. There are a lot of legal issues, but the key issue here is that we need, if the dollar is a weapon, then we need a multilateral framework of governance of sanctions. They need to set some rules that give clarity, transparency, and even certainty to countries that use the dollar that they will become victim or in improper sanctions or arbitrary sanctions, in particular if there is a change in the White House. And so the G7 should actually promote this multilateral framework that will help and clarify where we stand vis-a-vis the weaponization of finance, but mainly of the dollar. Thank you.
Thank you, Paola. I'm afraid that in the current international environment, it will be very difficult for the G7 to bring this issue to the table of the G20, for instance. But Zongguan Zhou, you have the floor, please.
Thank you very much for inviting me to participate in this very important conversation. And first of all, I wanted to just congratulate all the authors for making a very important contribution to the discussion of where the global financial system and currency system is moving forward. And I've been working on a lot of this stuff myself, but I do think that the presentation that you did today, as well as the paper that is circulated, is perhaps one of the most innovative paper that I've read in terms of, you not only very well defined what do you mean by the fragmentation of the global system, and you also clearly identified the channels that the global financial system as well as the global monetary system can become more fragmented. In other words, I think the way that you laid out in your presentation as well as in your paper makes it much more possible for us to qualitatively trace the causal mechanisms, and then perhaps next steps for some of our more hardcore quant people is to just figure out, which additional mechanism might contribute how much. But at least this is a very important first step for us to further move on to analyze the quantitative contributors. And then the second most important contribution that I think your presentation and your paper did is that you really do not only narrowly focus on the US-China rivalry and how China is going to challenge or dethrone the US dollar, and this is going to be the end of the dollar hegemon. Instead, I think you analyzed the broader global impact and the broader impact of not just the broader impact of not observing or violating central bank immunity as an informal practice. So I do think that this research that we've done is going to inspire future research on the scenarios and the mechanisms through which global financial and monetary system can become more fragmented. And I would also encourage you in the finalization of your paper to sort of more concretely identify the impact of such fragmentation, more specifically in terms of what are the secondary impacts, not just in terms of the role of the US dollar, but also perhaps for the development of the global development. And in particular, by saying this, I'm specifically thinking that since you are talking about the Bretton Woods system in the paper and how a lot of these institutions are, part of the pillars of the Bretton Woods system. But if the global system become more fragmented, does that mean that instead of having a Bretton Woods system, we are going to have an alternative or several alternatives? What this fragmentation may look like. Perhaps towards the end of your paper, you give us a more concrete picture where the global system is moving forward to. And then I would also want to sort of, after reading your paper, especially the clear mechanism that you identified from how the swaps work and so on and so forth, I do think that probably answering two additional questions would strengthen the argument of the paper. The first one that I'm thinking about is just following the train of thoughts that global system is becoming more and more fragmented, and countries like China is building an alternative financial infrastructure, financial system. Does that mean that going forward, the role of sanctioning countries that have, especially sanctioning countries that have access to the alternative system, might become less impactful or less effective? And what is the cost benefit, or in other words, the trade-off of future practice of sanctions? And I ask this question specifically because I struggle with this a lot myself in talking with US policymakers and stakeholders. The idea is, well, since Secretary Jack Lew several years ago already talked about, well, you just cannot use sanctions as if there's no cost. Every policy actions have a trade-off. So if the global system, especially since you identified the incentives, and I totally agree, the more we practice sanctions, in particular through the seas, and even potentially repurpose Russian foreign exchange, Russian foreign asset, and for central bank reserves, this is going to create a whole lot of new incentives for countries to say, I wanted to have access to the alternative. So what does this mean to the use of sanction, the practice of sanction going forward? Right. So in other words, I would encourage you to figure out, the trade-offs. And I know that this may not necessarily be the focus of the paper, but I think probably this could be really a cherry on top as well. And then related to this would be, I wanted you, since you guys have not just expertise as in the private market, but also as very, very, very experienced central bankers. So I wanted to sort of encourage you to put your central banker's hat on. And in particular, with regard to China, I think, there are so many ways that we can argue that, well, there is no way that the renminbi could be the renminbi asset or renminbi denominated asset could be as liquid or has as large market with regard to the US dollar denominated asset, both in terms of equity market, international loans and investment, as well as more specifically in terms of the market size and the liquidity of US Treasury bond. And in particular, the reason I pointed out US Treasuries is because I do think that it's one of the underappreciated aspects when people talk about the dollar dominance. I mean, if the US Treasury is the benchmark against which every other financial asset is going to be priced against, then that's a natural sort of like benchmark. It probably will be very difficult for the Chinese government or for China or for the PBOC to basically replace or create another zero risk benchmark. But to put it on your central banker's head, is it possible, what are the possible mechanisms that perhaps China can create a large enough demand for the renminbi-denominated asset without having to completely let go capital controls? Or if we work with the existing system, the existing history of how the dollar become the dominant currency, does that mean like having capital control is a must-have condition? I guess after all, one can argue that the Chinese market is large enough and China is developing an alternative trade mechanism through not WTO but actually bilateral FTAs. And on top of that, there is bilateral currency swaps, as you already talked about. But of course, whether China can continue to expand its network, galvanizing incentives around itself, is ultimately also dependent upon the trajectory of the Chinese economy. And I will just stop there, and congratulations to your paper.
Thank you. Very quick consideration from what you just said. We are all discussing without considering Trump possibly winning the next election and slapping 60% tariffs on China and 10% tariffs of all the rest of us, which would change probably the roots of international trade and then would affect this discussion. But I would say I would move again from I don't think there are questions that I have received.
Is there a question from the virtual?
Okay.
You have this question?
Let me see. I don't.
And we should also invite people here if they have. We have a couple of questions also from the audience.
Okay.
Just try to be very brief because we don't have much time.
We are running against time. Yeah. Please.
Grazie. Grazie mille. No, thank you very much. No, at the outstart, Scott Anderson said that seizure sounds like something irreversible from the point of view of international law. So I don't know if he said that because he was talking very quickly, but why not give as a guarantee in exchange Ukrainian government bonds, which are now worthless, but that if peace comes along and reconstruction begins in a few years, decades, they could become valuable. Secondly, why not start, I know this is a political issue, but why not start from Putin's weakest link, which is Belarus? Belarus is under sanction, it has frozen assets. I don't know the whereabouts, probably a Gulf state. They could be seized. Belarus is not at war with Russia. These amounts could be given, for instance, to the democratic opposition in exile. It's a political issue, but I think it's worth considering. Thank you.
Hi. China wants to be the top factory of the world, and it needs your independent currency. US is the top player in finance, and China doesn't want inside the American finance. Which is the balance?
I have now received the question from someone who is listening to us. Why did the US stop their work on the digital dollar? Probably they didn't even really start fully, according to some of the statements by Chairman Powell of some weeks ago, if one of its aims of the virtual dollar of the was to contain the de-dollarization, why did the U.S. stop on their tracks on this? This is the question. So I would start with Mrs. Mostri and then Franco for second time.
Well, I don't know whether I can make a lot of remarks on political suggestions. As I have said, for us, what we look at is to preserve the risks for our company. And what we have noticed and what we have mentioned, that is, if frozen assets are used as collateral to raise money, then that means that our assets are encumbered and that we have a lack of assets against the liability that remains towards the central bank. So that does not change. I don't really follow the logic on going after Belarus money. But that is a political discussion on which I don't think I can comment a lot.
Okay, we have 1 minute, and it would take 2 hours to answer. Just one thing that I care very much is to prove that hopefully Lorenzo is wrong, because if Lorenzo is right, we are really in big trouble. Now, he's right in terms of relative weight of the dollar versus the euro. Euro has a lot of exposure, much higher exposure to Russia than the dollar. Plus, there are also commercial treaties between European countries and Russia, which make European countries vulnerable to claims. So there is definitely, plus Europe has no banking union, so on and so forth, so forth. But I mean, in absolute terms, I think that also the dollar is going to be, and as Zoe mentioned, you know, this instrument, if it's used repeatedly, will become less effective. So I think that eventually also the dollar will be penalized. One question that Zoe asked, why, and many ask, why China does not promote an asset, what does not liberalize its capital market, that's something that for me is very difficult to understand, because it's mainly a political, you know, I was in the Bank of Italy when Italy had the $20 billion of reserves, and we never really introduced capital controls in the 90s. So it's very difficult to understand why a country with 3 trillion of reserves is concerned that there could be a capital flight. So that is mostly a political, but certainly unless that happens, the demand for the renminbi will never be high. It's true that if you use a currency for payments, it's like when you pay, you know, you need to have a checking account because you use your currency to pay, but that it will not become a major currency. Why that doesn't happen, it's more of a political problem than an economic problem. I think China would have all to gain by really changing its economic model, liberalizing, and becoming a very important currency. Thank you.
So, thank you.
Read a speech by the previous vice chairman of the Federal Reserve System, Randy Quarles, who made a speech explaining why the Fed thinks that it's not the role of a public institution to enter the business of payments between private citizens, which is very clear, and that it would undermine the US financial system. And this is the key difference between Europe and the US. The US would never do a public action which would undermine the role of the financial system, because it considers the financial system is part of the whole economy. In Europe, the financial system is considered very often as a source of either excess profits or trouble, which it is, and so it needs to be regulated. And so the way in which I think the politicians and public authorities think in the US and Europe with respect to the financial sector is very different. And you see this in specific examples like the central bank digital currency, which in the US is considered to be a matter for private institutions.
This will be the matter for another 2 hours, at least 2 hours of discussion, and but we will leave it at that for the moment.
Yeah, just to say that now a cocktail is served in the terrace. So many thanks all of you for accepting our invitation, and we certainly will continue discussing this very important issue that will be also one of the matters that will be discussed at the G7, as I said at the beginning, in June. So we will see what will come out of this meeting. So, bye-bye.